Hello everyone and welcome back. In this video, I want to talk about how you can become the top 0.1% of investors. How to invest like the best. How to invest like Warren Buffett. If you want to pick great stocks and you want to outperform the market for many decades to come, you have some things to consider when it comes to quantitative analysis, but also qualitative analysis, but also temperament. Warren Buffett, when he was asked what is the most important thing in investing, he said temperament. And in this video, I want to talk about temperament, how people react when stocks are going down. What are the key tips you need to know to make the best possible decisions when stocks are going down? I will give you specific tips, specific advice, so you can manage your portfolio the good way, so you know how to react when stocks go down for the future. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of roughly 25% per year. And every time you had a crash, every time you had an opportunity, a correction for the global market or for specific stocks, you have to decide. Either you cry and you panic sell, or you hold your nose and you just wait it out, you ride the stock, or you buy heavily. And depending on specific things, you will decide. You have to have a gut feeling, an analysis, some due diligence, and you have to make a decision. So a lot of people ask me how to decide when a stock is going down, how to decide if you have to buy and double down, or do you have to hold, or you have to sell, because you will have more risks for this stock. The only answer to this is it depends on you. How do you know how to answer this question? Well, it's about research. And now I want to talk about what happens before you buy. Before you buy a stock, you are talking about the numbers, the revenue, the margins, the net income, the free cash flow, the capital allocation decisions. What you can do is to check the past 20 years of the company. Check the track record of the company. Check how the management reacted when the stock price crashed in the past. A good way to know if a management team will do the right thing and the stock price will rebound in the future is to look at how they performed in the past, how the management reacted. For example, I can give you some specific tips, some specific names. You have a company that sells wooden connectors in the US called Simpson Manufacturing. Every 5 years, they have a plan. They have a guidance for the next 5 years, and you have a sector that is cyclical, related to the housing industry in the US, and wood, so raw materials, very cyclical, and they have plans for the next 5 years. You can check for the past 20 years if every time they reached their goals, and you can check how they were impacted by the cyclicality. You can check how they reacted in 2008. In 2008, you had a real estate crash. How did the management team of Simpson Manufacturing react? Well, they talked about the vision of the long term. They talked about a choice. Either they could survive the recession, lower their prices, lower the quality of their wooden connectors to have a lower quality product to sell, or they could just never decrease the quality. Talk about stickiness of clients. I will let you do the work online. But what I can tell you is the management team of Simpson Manufacturing, the ticker symbol is SSD, is very prudent. They know exactly what they're doing to survive for the long term, to increase their competitive advantages in the past. And every time you had a crash, every time you had a stock market correction, they took advantage of it. So they thrive out of chaos. You don't have many companies that thrive out of chaos. If you can fill your portfolio with companies that thrive out of chaos, you will reduce your stress. You will reduce your anxiety. This is what Warren Buffett means when he says temperament. It's temperament, but also preparation. If you have done the work before, you know that the track record of the company is great, you know that the management team is very smart, you know how they reacted in the past when the stock price crashed in the past, you will feel much less anxiety in the future. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. You will know if you like the odds, you can just buy the dip. You will not panic sell because you have done the work before. So one thing that can help you decide is the due diligence, the research. How good do you know your company? And all this due diligence will give you conviction. Now that you have done the work before, you have done the preparation work before, something else you can write before buying a stock is what can go wrong. Before buying any stock, you note, you take a Word document and you write 5, 10 things that could go wrong for the stock, could go wrong for the company. These can happen, and this can happen. The margins can drop because of this, or you have more competition out of this, and this, and this, and this. You can list all the things that can happen, and you can prepare beforehand. What will I do if this risk materializes? What will I do if this happens, if this happens, and this happens? The goal of the exercise is to think in your head before the stock crashes. Because when stocks crash, I'm thinking about April 2025, Liberation Day, you will see a lot of panic in the market. People will freak out. People will think that this is the end of the world. Or I'm thinking about the COVID situation in March 2020. People freaked out. People thought it was the end of the world. And for good reasons, we didn't have much data. We saw numbers of deaths accumulating. So the world was quite bad at the time. It is not at this time that you have to think about your stocks. It's before. You will not have the time to do the work in this panic time, panic zone, because your vision will be blurred. I'm telling you, I've seen this countless times. When you are surrounded by panic, it's too easy to become emotional. But if you have written in the past all the preparation work, you know exactly what you have to do beforehand. The goal is to have a clear mind, okay? To have an action plan before the stock is dropping. And this is what Warren Buffett means when he talks about temperament. Very few people can prepare like this. Some people will be controlled by their own emotions. And when they will see some red on their screens, they will see their portfolio shrinking, they will panic sell because they say, I don't know, I'm out. Most likely, this is the worst thing to do. If you own great companies, great quality companies, led by great management teams, selling is the ultimate worst thing, okay? Because normally, good management teams will take advantage of the situation to either acquire a competitor, for example, or either make their biggest buyback program ever, or you will have some insider buying. The CEO will buy more shares, or they will just revamp the business model, reduce the workforce, fire some people to become more efficient, and improve the earnings per share. Good management teams will always thrive in chaos. You can look at Mark Zuckerberg in 2022. The world was quite bad for Meta Platforms shareholders in 2022. I was a shareholder. I've been a shareholder of Meta Platforms since 2018, and I bought the dip in 2022 because I had done the work before. What can go wrong and this and this? Do I really know this? And by doing the work, by the way, you will know if something is inside your circle of competence for real. If after all this preparation work, you are still not sure, you don't have the conviction, it means it's out of your circle of competence. It's not for you. The stock is not for you. It's okay. You dismiss it and you only invest in companies that you really understand. You know all the growth prospects. You know all the potential risks. You know every time the stock dropped, how the management reacted. This is what it means doing the due diligence. Doing the research is not only looking at the revenue growth. Doing the due diligence is looking at the incentives, the track record, what the management said in the past, how they reacted. Do they think about the short-term profits or the long-term sustainability of returns? It matters. Do they think about widening the moat or shrinking the moat to boost short-term results to please Wall Street? These are the kind of qualitative elements that you will not find on investing websites. And this is why I love my job. Because as a detective, you can just check what the management said in the past. And now everything is free. Use Gemini. Everything is free now. On the internet, you can have all the information you need if you know how to find it. This is a key differentiator right now. People have too much information. They think that reading more means better. I disagree strongly. If the more you read, the dumber you become, because you read a little bit of everybody, but not everybody is smart. So maybe you are reading something that is really wrong. Okay? A key differentiator now in this golden age of information is to know what is good from what is wrong, what is the important information and what is not important at all, what is noise versus what is signal. And very few people know how to do it. And it is what we work on inside my coaching program. How to know if something is important or just noise. So by doing the work, the research, the due diligence, it will give you conviction. And when there is a market crash, you will no longer ask, do I double down? Do I buy the dip? Or do I sell? Because you know in advance. You know if the management team is bad and it was just a speculative play, so you can sell. Or you know how the management team will react. I have some specific examples in my portfolio. I have MSCI, great track record. Every time the stock dropped, they increased their buyback program and the CEO bought shares for his own family. Every time. Same thing for Fortinet, a company in the cybersecurity industry. Every time the stock dropped, they did more buybacks and the management team owns 15% of the company. So the incentives are aligned. Every time the stock drops, it's a great opportunity to buy more. So they invest in themselves, they do massive buybacks every time the stock is dropping. Okay, so you want to invest in simple companies, you know they will do great. If there is a stock market crash, either it's a hold or it's a buy the dip opportunity. You will avoid these situations. If you only invest in quality companies, you remove anxiety from your life. And by doing the work, doing the due diligence, you can put yourself in the top 0.1% of investors and you can finally outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.